Tom Lee, co-founder and head of research at Fundstrat, just went on CNBC's The Exchange to share why he believes Bitcoin is now a reliable leading indicator for the S&P 500, and why that could mean a massive breakout is coming in stocks. He also dropped some bold predictions about Ethereum that could be just as explosive. In a moment, I'm going to play you the full clip of Tom Lee's interview so you can hear exactly what he said. Then, I'll give you my own reaction and a detailed breakdown of the key points he made, including what it could mean for your portfolio. And stick around because after that, I'm going to reveal 2 growth stocks I believe you can buy now and hold forever. The kind of picks that could benefit big if Tom's outlook plays out. If you only watch one investing video today, make it this one, all the way until the end. So before we get started, do me a quick favor. Smash that like button, let's hit 1,000 likes on this one, share it with a friend who follows the markets, and drop your thoughts in the comments. And of course, subscribe so you never miss the next big investing update. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Alright, let's roll the clip and hear exactly what Tom Lee had to say.
Joining me now is Tom Lee, head of research at Fundstrat and a CNBC contributor. It's so good to have you here on set. Welcome.
Yeah, great to see you, Morgan.
Let's start right there. Bitcoin is a leading indicator. What's it indicating now?
Well, Bitcoin has been 1 month ahead of the S&P at every step this year. In January, it peaked before the S&P. It bottomed before the S&P in April. It made a new high in May, a month ahead of the S&P. And in early July, on July 9th, Bitcoin had a breakaway upside move, gaining more than 10%. That means that in this month, I think the S&P is going to have a breakaway move to the upside, towards 6,600.
Interesting, which sort of takes us to where you think the S&P is going to be priced for the year.
Well, I think that at least 6,600 is a minimum, because if we're making 6,600 in the next few weeks, then I think that probably 7,000 is a level we could touch by the end of the year.
Really?
Yeah.
What propels us to that?
Well, I think that 3 things are happening. One is the economy has survived tariff Armageddon, and it's probably strengthening because we know the ISM's been stuck below 30 or 50 for 30 months now. So finally, ISM could go above 50. The second is that we're getting closer to the Fed making a dovish pivot. I mean, they've been on hold for a long time, similar to how Kelly's birth is on pause, but that, I think, leads to a re-rate of multiples. And the third is that I think sentiment's still quite bearish. I think there's many of our clients that think we're going to have a recession because of the tariffs that started on August 1st. But I think businesses are ready to actually get through that. And that sentiment collapsing actually helps PEs.
Okay. Let's talk about Ethereum, because I know you're very bullish on that as well. We'll get into Bitmine in a second, too. But Ethereum specifically, why is this something you need to hold in your portfolio?
Well, to me, Ethereum's having its Bitcoin 2017 moment again. And to give perspective, in 2017, Bitcoin was under 1,000. But that was the year when Wall Street discovered that the narrative of Bitcoin is digital gold. And Bitcoin has gone to 120,000 now. So 120 times increase. In 2025, a couple things are happening around Ethereum. The first is the Genius Act is now making stable coins kind of green lighted, which is the ChatGPT moment for crypto, but it needs a smart contract, so it doesn't work on Bitcoin. The second is the SEC is pushing forward with Project Crypto, which is actually asking Wall Street to move the entire financial system onto the blockchain. Ethereum is the preferred choice for Wall Street because it's had 0 downtime since inception, matching what the banks want, 100% uptime. It's also the most legally compliant and secure blockchain because it's recognized in the US and it's the second largest blockchain. And the third is almost all of it is taking place on Ethereum. JP Morgan's building their stablecoin on Ethereum. Robinhood is tokenizing on Ethereum. The custody banks are doing it on Ethereum. So it's really where Wall Street meets, but that's also where AI is meeting crypto. Because as you know, as we tokenize and move towards robots, you need a token economy to control them, which is taking place on Ethereum.
And which is why you're now the chair of Bitmine, which is looking to build out this treasury of Ethereum, not so differently than we've seen Michael Saylor do with Bitcoin at Strategy.
Yes, that's right. So I think that MicroStrategy has written the playbook for what a Bitcoin treasury is, and now he's so big he has a sovereign put, right? He has 600,000 Bitcoin. Any nation that wants to get 1 million Bitcoin probably thinks it's cheaper to buy MicroStrategy. The Ethereum treasury model, which is we're trying to be the MicroStrategy of Ethereum, works similarly, but we're at the earliest stages, because if this is the 2017 moment for Ethereum at 3,700, it could make a move to 30,000 or more. On top of that, Ethereum pays you for providing network security by staking. That's a 3% yield. So BitMine owns over $3 billion worth of Ethereum. When we start staking and it's legally compliant, all within the US, that's more than $100 million of revenue. Of net income. So it's a profitable treasury company. And we've been able to grow our holdings of Ethereum from roughly $4 per share in 30 days ago to over $25 today. So it's adding about 80 cents to $1 worth of ETH every day.
Interesting. I mean, when I think about strategy, it is really it's the whale in the Bitcoin market, just because they have been buying up so much Bitcoin. So if BitMine is taking a similar approach to Ethereum, where do you see prices for Ether going?
Well, I looked at some research from Sean Farrell, who's our head of digital asset strategy, and he put out a presentation about Ethereum today. So he thinks the ratio of Ethereum to Bitcoin could go back to its 2021 highs, which is about 0.14. That would value Ethereum today at around 16,000, and it's currently 3,700. So he's just saying Bitcoin ratio versus ETH, let's get back to where it was 5 years ago, which makes sense because it's a better story today than it was in 2021, and that gets you, close to 16,000.
Let's start with the first bombshell. Tom says Bitcoin is now acting as a leading indicator for the S&P 500. And this isn't just some casual observation. He lays out a timeline showing how Bitcoin's moves have been front-running the S&P's moves all year. January, Bitcoin peaked a month before the S&P did. April, Bitcoin bottomed out, and then a month later the S&P followed. May, Bitcoin hit a new high a month before the S&P, and then early July, boom. July 9th, Bitcoin surged more than 10% in a single move. In Tom's mind, that's a signal. If Bitcoin has consistently been leading the S&P by about a month, then a breakout in Bitcoin in early July means we could see a breakout in stocks this month. His words, a breakaway move towards 6,500 or even 6,600 on the S&P, and he's not stopping there. He says if we get to 6,600 that quickly, then 7,000 by year-end is absolutely in play. Now, why is he so bullish on stocks when so many people are still talking about recession risk? He gives three main reasons. 1. The economy survived tariff Armageddon. Remember the wave of tariffs that kicked in on August 1st? A lot of people, including his own clients, assumed that was going to crush growth. But Tom says the economy seems to be powering through. The ISM Manufacturing Index, which has been stuck below 50 for 30 straight months, signaling contraction, might finally be moving back above 50. If that happens, it means expansion is returning. 2. The Fed is near a dovish pivot. The Fed's been on hold for a long time. No hikes, no cuts. But Tom thinks a shift toward cutting rates could be coming. And a Fed pivot tends to push valuations higher because lower rates make equities more attractive. 3. Bearish sentiment is fuel. The irony of markets is that when too many people expect a crash, it often doesn't happen. Tom says a lot of investors are still bracing for recession. If that fear starts to fade, it could create a wave of buying, especially if economic data keeps improving. Then, Tom shifts gears. And here's where it gets interesting for the crypto crowd. He believes Ethereum right now is in the exact position Bitcoin was back in 2017, before its massive explosion. Back then, Bitcoin was under $1,000 when Wall Street suddenly embraced the digital gold narrative, and that drove Bitcoin up 120x to where it sits today. For Ethereum, Tom sees three big catalysts. 1. The Genius Act and stablecoins. This legislation effectively greenlights stablecoins, and Tom calls it the ChatGPT moment for crypto. Why? Because it opens the door for mass adoption in ways that require smart contracts, which Bitcoin doesn't have, but Ethereum does. 2. Wall Street moving finance to the blockchain. The SEC's Project Crypto is actively encouraging the migration of financial infrastructure to blockchain, and according to Tom, Ethereum is the preferred platform because it's had zero downtime since inception, offers the legal compliance big banks need, and has the security credentials to match. 3. Real-world adoption by big institutions. JP Morgan's stablecoin, built on Ethereum, Robinhood's tokenization plans, Ethereum, custody banks, Ethereum again. And Tom's big point is that this is where AI and crypto intersect. Tokenized economies that can power automated systems, all running on Ethereum. Tom's not just talking theory here, he's actively involved. He's now chair of Bitmain, and the strategy is to create an Ethereum treasury in the same way Michael Saylor's MicroStrategy created a Bitcoin treasury. MicroStrategy bought so much Bitcoin that it's now almost a sovereign-level player, holding around 600,000 BTC. Tom's vision is for Bitmain to do the same with Ethereum, but starting earlier in the growth curve. Here's why he's excited. Ethereum is currently around $3,700, but he thinks it could run to $30,000 or more in this cycle. Staking ETH generates a 3% yield, so holding billions in Ethereum can produce hundreds of millions in annual income. Bitmain's ETH holdings have grown from $4 per share to over $25 in just 30 days, adding about 80 cents to $1 worth of ETH every day. Finally, Tom cites research from Sean Farrell at Fundstrat, who says the ETH to BTC ratio could return to its 2021 highs of 0.14. If that happens, Ethereum's current price of $3,700 could rise to around $16,000. And Tom believes the fundamental story for ETH is actually stronger now than it was in 2021. So, here's the bottom line. Tom Lee is laying out a case where Bitcoin is leading stocks higher, the S&P could blast past 7,000 this year, and Ethereum might be on the verge of a multi-year parabolic move. Now, of course, these are bold predictions, and markets have a way of humbling anyone who gets too confident. But if even part of what he's saying plays out, both equities and crypto could be in for a very big second half of the year. And as always, the market doesn't wait for the doubters to get comfortable. Let's start with our first company, a true powerhouse in the world of cosmetics, E.l.f. Beauty, ticker symbol 𝗟𝗓. If you haven't heard of them yet, you're about to see why they're making waves not just in the beauty industry, but across the entire retail landscape. This is a brand that's rewriting the rules of what it means to be a modern beauty company, and their story is just getting started. If you've walked through any major retailer's beauty aisle lately, you've probably noticed their products everywhere, on end caps, at eye level, and even in the hands of shoppers of all ages. And there's a very good reason for that. E.l.f. has absolutely mastered the art of delivering high-quality, on-trend, vegan and cruelty-free products at prices their competitors simply can't touch. Their formulas rival those of luxury brands but without the luxury price tag, making them accessible to everyone. Gen Z and millennials are especially hooked. For these younger consumers, premium makeup doesn't have to cost a fortune. They want products that are ethical, effective, and affordable, and E.l.f. delivers on all fronts. While legacy brands are still charging $30, $40, or even more for a single product, E.l.f. consistently delivers for under $10. This price point isn't just a marketing gimmick, it's a core part of their mission to democratize beauty for everyone. But it's not just about price, it's about speed, agility, and smart execution. E.l.f. is known for its ability to move faster than almost anyone else in the industry, launching new products at a pace that keeps them ahead of the curve. E.l.f. is lightning fast at spotting viral trends on TikTok and Instagram, and they're able to release their own versions in record time. This means they're always relevant, always in the conversation, and always top of mind for trend-savvy shoppers. Instead of spending millions on traditional advertising, E.l.f. leverages the power of influencers and user-generated content. Their marketing is grassroots, authentic, and community-driven, creating a marketing machine that feels organic and trustworthy. Their products go viral organically because they're genuinely good, incredibly affordable, and perfectly in tune with what's trending. This isn't just luck, it's a deliberate strategy that's paying off in a big way. This creates a powerful feedback loop of hype and sales that keeps accelerating. The more people talk about E.l.f., the more their products fly off the shelves and the more buzz they generate online. Now let's dig into the numbers because the financials tell a story of explosive growth and smart management. For the fiscal year ending in March, E.l.f. reported a staggering 77% increase in net sales, topping $1 billion for the very first time in its history. That's a milestone that puts them in a whole new league. Even more impressive, that's 21 consecutive quarters of net sales growth, over 5 years of uninterrupted expansion. In the beauty industry where trends can change overnight, that kind of consistency is almost unheard of. In an industry notorious for its fickle trends and ever-changing consumer preferences, E.l.f.'s ability to keep growing quarter after quarter is a testament to their adaptability and deep understanding of their audience. So, what's driving this remarkable performance? It comes down to strategic brilliance on multiple fronts: product, marketing, and execution. First, their market share gains are off the charts. E.l.f. is now the #3 mass cosmetics brand in the U.S., leapfrogging industry veterans who once seemed untouchable. They've gained market share for 21 straight quarters, which shows this isn't just a temporary trend, it's a real, lasting shift in consumer preference. People are actively choosing E.l.f. over the brands they grew up with, signaling a generational change in the beauty aisle. Second, their expansion into skincare has been a massive success. Skincare is a huge and growing market, and E.l.f. has entered it with the same disruptive approach that made their makeup a hit. They've launched effective, clean, and affordable skincare products, opening up a whole new revenue stream and deepening customer loyalty. Now, E.l.f. isn't just a makeup brand, it's a full-fledged beauty destination. A customer who buys E.l.f. makeup is now likely to try their cleansers and serums, boosting their lifetime value and making E.l.f. a one-stop shop for all things beauty. Third, their international growth story is just beginning. While they've dominated the U.S. market, they're now setting their sights on the rest of the world. They're expanding into Canada and the UK and already seeing rapid market share gains in these new territories. The appetite for affordable, high-quality beauty is global. The global market is a massive opportunity for E.l.f. to replicate its U.S. success, and there's every reason to believe they can do it, given their proven playbook. And let's not forget about profitability. While many fast-growing companies struggle to turn a profit, E.l.f.'s bottom line is soaring. Adjusted net income jumped an incredible 126% last year, proving that their business model is not only scalable but also highly efficient. They're not just growing, they're growing profitably. They're managing costs with discipline and translating top-line growth directly to the bottom line. In other words, E.l.f. is a cash-generating machine, which gives them the flexibility to keep investing in growth. Some might look at the stock's recent run and think the best days are behind it, but I strongly disagree. The fundamentals are only getting stronger. When a company is fundamentally reshaping an industry, capturing market share from entrenched competitors, and has multiple growth avenues ahead, the story is far from over. In fact, it may just be getting started. Their innovation pipeline is packed with new launches, brand loyalty is fierce, and CEO 𝗗𝗟𝗦𝗧's leadership team is executing with precision and vision. E.l.f. has become the go-to brand for modern consumers who value ethics, quality, and affordability. Their appeal cuts across age, background, and geography. They're not just selling makeup, they're selling an identity, a sense of belonging, and building a passionate community around their brand. This is the kind of loyalty that can last for decades. This is a powerful moat that legacy brands can't easily penetrate. E.l.f. has built a fortress around its business by combining value, speed, and community in a way that's hard to replicate. The company's guidance remains strong, projecting continued double-digit growth in the years ahead. Management is confident, and the numbers back them up. They're investing heavily in marketing, innovation, and international expansion to capture the massive opportunity that still lies ahead. Every move is calculated for maximum impact. While competitors are playing defense, trying to protect their shrinking turf, E.l.f. is playing offense, innovating, expanding, and winning new fans every day. When I look at E.l.f., I don't just see a beauty company, I see a disruptive tech company that happens to sell makeup. Their approach is data-driven, agile, and relentlessly focused on the customer. They use data, speed, and community insight to outmaneuver the competition, constantly refining their products and marketing to stay ahead of the curve. Their formula for delivering hit products at unbeatable value is a recipe for long-term success. Customers know they're getting quality and innovation without breaking the bank. E.l.f. currently holds a market cap of $5.87 billion, with earnings per share at $1.99 and a price-to-earnings ratio of 51.14. The company reported $1.31 billion in revenue for 2024, net income of $112.09 million, and is trading at $101.77, nearly 49% below its estimated fair value of $151.57. Recent earnings gave investors reason to cheer, with quarterly revenue hitting $353.7 million, up 9% year-over-year, and adjusted EPS coming in at 89 cents, beating analyst expectations of 84 cents. CEO 𝗗𝗟𝗦𝗧 pointed out that the company has increased market share by 210 basis points over the past 26 consecutive quarters. His appearance on CNBC's Mad Money further highlighted the company's momentum and its ongoing focus on delivering value to customers, which could help boost investor sentiment. But it wasn't all good news. Despite higher sales, net income fell 30% compared to last year, with margins feeling the squeeze from tariffs. Adjusted EBITDA margins are expected to decline from 23% to 20% in the coming quarters, a warning sign for profitability. So while the brand continues to gain market share and deliver strong top-line growth, the real question is whether it can protect its bottom line against mounting cost pressures and market volatility. For me, E.l.f. remains a compelling growth stock that's still in the early innings of its global story. The runway ahead is long, and the potential is enormous. Now, before we move on, if you're enjoying these stock tips and want to level up your investing skills, check out my Value Stocks Investing Master Course. It's the perfect next step if you want to take your investing to the next level. This course is designed to teach you the timeless principles used by investing legends like Warren Buffett and Benjamin Graham, principles that work in any market, for any investor. You'll learn how to spot undervalued companies, build a high-quality portfolio, and protect your investments from market volatility and risk. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's about building a foundation that lasts. It's packed with step-by-step lessons, practical strategies, and real-world examples you won't find anywhere else. You'll walk away with actionable insights you can use immediately. If you're serious about investing smarter and want to join a community of like-minded investors, click the link in the description to join today. Don't miss out on this opportunity to transform your financial future. Now let's get back to our second explosive growth stock, one that's shaking up a completely different industry and could be the next big winner in your portfolio. Our second company is a name you'll be hearing a lot more about, 𝗂𝗑 Group, ticker symbol 𝗂𝗑. While it may not yet be a household name like some of its fast casual peers, 𝗂𝗑 is quickly making waves in the restaurant industry and on Wall Street. Investors and foodies alike are starting to take notice, and for good reason. 𝗂𝗑 is pioneering fast casual Mediterranean cuisine, bringing fresh, vibrant, and customizable bowls to the masses. Their menu is inspired by the bold flavors and wholesome ingredients of the Mediterranean diet, which is widely recognized as one of the healthiest in the world. From crisp greens and roasted vegetables to tangy dressings and perfectly grilled proteins, every bowl is a celebration of color and nutrition. They've tapped into a huge shift. Consumers want healthier, fresher, and more interesting food, even on the go. Today's diners are looking for meals that fit their active lifestyles, and 𝗂𝗑 delivers with options that are both satisfying and nourishing. Whether you're vegan, vegetarian, gluten-free, or just looking for something new, 𝗂𝗑's menu has something for everyone. 𝗂𝗑's concept feels premium and wholesome, but at a speed and price that rivals traditional fast food. The atmosphere inside a 𝗂𝗑 restaurant is modern and inviting, with an emphasis on transparency and quality. You can see the ingredients, watch your meal being assembled, and enjoy a dining experience that feels elevated without breaking the bank. Their assembly line format allows for incredible customization and efficiency, making it highly scalable. This operational model not only keeps wait time short, but also empowers customers to build their perfect meal, ingredient by ingredient. It's a system that's proven to work, and it's one of the reasons 𝗂𝗑 can expand so rapidly. This model can be replicated consistently across the country, a key to successful restaurant expansion. 𝗂𝗑's ability to maintain quality and service standards as it grows is a testament to its strong operational foundation. As more locations open, the brand's presence and influence continue to grow. Let's look at the financials. 𝗂𝗑's growth story isn't just about buzz. It's backed by impressive numbers and a clear path to profitability. In Q1 2024, 𝗂𝗑 opened 14 new restaurants, bringing their total to 323, a 22.5% increase year over year. That's a remarkable pace of expansion, especially in a challenging economic environment. Each new opening brings 𝗂𝗑's unique flavors to a wider audience and strengthens its brand recognition. Management sees potential for over 1,000 𝗂𝗑 restaurants in the U.S. by 2032. That's a bold vision, but given their track record and the growing demand for healthier fast casual options, it's not out of reach. The company is strategically targeting markets where consumer preferences align with their brand, ensuring each new location has a strong chance of success. But it's not just about opening new stores. Their existing locations are thriving. High foot traffic and strong customer satisfaction are driving repeat business, which is crucial for long-term growth in the restaurant industry. Same-restaurant sales grew 2.3% in Q1, on top of a massive 28.4% growth the previous year. This kind of sustained momentum is rare and signals that 𝗂𝗑's concept is resonating deeply with its core audience. Customers aren't just trying 𝗂𝗑, they're coming back again and again. The brand is building a loyal following, with many guests making 𝗂𝗑 a regular part of their weekly routine. That kind of loyalty is the foundation of any great restaurant brand. Revenue jumped 30% to over $256 million, and they're profitable, reporting $14 million in net income for the quarter. For a company in rapid expansion mode, turning a profit this early is a major achievement and a sign of disciplined management. Their restaurant-level profit margin is a healthy 25.2%, showing strong efficiency. This means 𝗂𝗑 is not just growing for growth's sake, they're doing it in a way that creates real value for shareholders and stakeholders alike. A key move was acquiring Zoe's Kitchen and converting prime locations into 𝗂𝗑 restaurants, accelerating their expansion. This strategic acquisition gave 𝗂𝗑 access to valuable real estate and allowed them to scale up quickly without starting from scratch in every market. Looking ahead, management plans to open 54 new restaurants this year and projects same-restaurant sales growth of 4.5% to 6.5%. These targets reflect both confidence in their model and a disciplined approach to expansion, balancing growth with operational excellence. 𝗂𝗑𝗏's brand resonates with modern consumers, and their operating model is proven and profitable. The company's focus on quality, speed, and customization is exactly what today's diners are looking for, and it's helping 𝗂𝗏 stand out in a crowded market. They're not just another restaurant chain, they're defining the fast-casual Mediterranean space, much like Chipotle did for Mexican food. 𝗂𝗏 is setting the standard for what Mediterranean fast-casual can be, and competitors are starting to take notice. Their digital strategy is a major differentiator. In an age where convenience is king, 𝗂𝗏's investment in technology is paying off, making it easier than ever for customers to order, customize, and pick up their meals. 𝗂𝗏's mobile app and loyalty program streamline ordering and provide valuable customer data. The app is intuitive and user-friendly, encouraging customers to return and engage with the brand beyond the restaurant walls. This enables targeted marketing and personalized experiences, driving loyalty and repeat business. By understanding what their customers love, 𝗂𝗏 can tailor promotions and menu offerings, deepening the connection with their audience. In today's world, being a tech-savvy restaurant operator is essential, and 𝗂𝗏 is nailing it. Their use of digital kitchen systems and data analytics helps streamline operations and ensure consistency across every location. CEO 𝗗𝗟𝗏𝗦 and his team have a clear vision, focusing on strong unit economics and long-term value. Their leadership is committed to sustainable growth, innovation, and building a brand that can stand the test of time. They're building an enduring food brand with the potential to become a household name nationwide, and maybe globally. As 𝗂𝗏 continues to expand, its influence on how Americans eat and think about fast food will only grow. Combine the trend toward healthier eating, a scalable and profitable model, a long runway for growth, and flawless execution, and you have a truly special growth stock. 𝗂𝗏 is uniquely positioned at the intersection of food, health, and technology, a combination that's hard to beat. The company has a market cap of $9.83 billion, EPS of $1.24, a PE ratio of 68.59, and reported $963.71 million in revenue for 2024, with net income of $130.32 million. 𝗂𝗏 has been expanding its footprint, recently opening its first restaurant in Pittsburgh near the University of Pittsburgh, a move in line with its growth strategy to break into new markets. The company has also been creative with marketing, launching pita chip plushies alongside its hot harissa meal, a quirky and engaging campaign aimed at strengthening brand loyalty and boosting sales. Investors are now watching closely for the company's Q2 earnings report on August 12, 2025. Analysts expect strong sales growth despite some cost pressures, and anticipation is keeping the stock on many traders' radars. Still, the recent pullback in share price and a mixed outlook for earnings could create short-term headwinds. For 𝗂𝗏, the challenge will be maintaining the right balance between aggressive growth and managing operational pressures as it works to solidify its position in the fast-casual dining space. 𝗂𝗏 Group is firing on all cylinders, and I believe we're witnessing the rise of the next great American restaurant success story. With every new location, they're not just serving food, they're shaping the future of fast-casual dining. It's a company long-term investors should be watching closely, as 𝗂𝗏's journey is just getting started and the potential ahead is enormous. So, there you have it. Two incredible growth companies, E.l.f. Beauty and 𝗂𝗏 Group, each making waves and dominating their respective fields in ways that are truly impressive. Both brands have not only captured the attention of consumers, but have also set new standards for what's possible in their industries. E.l.f. is a masterclass in modern marketing and value creation, delivering premium quality without the premium price. Their ability to connect with younger audiences through social media, influencer partnerships, and viral campaigns has set them apart from traditional beauty brands. They've built a loyal community by listening to their customers and constantly innovating their product line. Meanwhile, 𝗂𝗏 is redefining fast food, meeting the demand for healthier, fresher options with a model built for rapid expansion. Their focus on Mediterranean flavors, customizable meals, and a tech-forward ordering experience has resonated with health-conscious diners and busy professionals alike. Both companies benefit from visionary leadership, powerful brand loyalty, and a clear path to continued profitable growth. Their management teams have demonstrated the ability to adapt quickly to changing market trends and consumer preferences, which is crucial for long-term success. These are the kinds of disruptive businesses that can generate tremendous returns for investors who get in early. If you're looking for companies with the potential to outperform the market, these are prime examples of what to watch for. If you're enjoying these stock tips and you're ready to level up your investing skills, I've got something game-changing for you. I've just relaunched my Value Stocks Investing Master Course, designed to teach you the exact principles used by investing legends like Warren Buffett and Benjamin Graham. But this isn't just theory. You'll learn how to spot undervalued companies using real-world metrics, build a high-quality portfolio, and protect your investments no matter what the market throws at you. Whether you're just starting out or want to sharpen your strategy, this course gives you the tools and confidence to grow real, long-term wealth. It's packed with step-by-step lessons, powerful insights, and practical strategies you won't find anywhere else. So if you're serious about investing smarter and building a future you're proud of, click the link in the description and pinned comment to join today. Trust me, your future self will thank you. And for exclusive stock tips, in-depth analysis, and real-time trade alerts, join the Stocks Galore Patreon community, link below. You'll get access to a supportive group of like-minded investors and my latest insights before anyone else. Now for today's question. Between a disruptive beauty brand like E.l.f. and a pioneering restaurant chain like 𝗗𝗧, which business model do you think has more long-term growth potential and why? Is it the scalable, digital-first approach of E.l.f. or the innovative, health-focused dining experience of 𝗗𝗧? I'd love to hear your thoughts and reasoning. Let me know in the comments below. Your insights and perspectives always add so much value to our community, and I look forward to reading your answers. Don't forget to like, share your thoughts, and subscribe so you don't miss the next big investing update. Your support helps this channel grow and reach more aspiring investors. Thanks for watching, and I'll see you in the next one. Until then, happy investing.